When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll answer listener questions and then talk about why you need a new financial planner. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom with solid advice, they come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing this weekend?
Doing great. How are you doing?
I'm doing great, thank you. Always glad to be with you here on the radio, talking to fine people here of the greater Tucson area. We've got a lot to talk about on today's program. A lot of things happened this past week with the market, Jeff. It was up, it was down again, then it was up again. And it occurs to me that President Trump is doing a lot of things on a really rather quick basis. How do you think this is all going to shake out with the market? And can what we expected happened this past week with the ups and downs be what we can expect here for the next 4 years?
No, it can't be the same daily like it has been for 4 years. There's going to finally come a reset. Now, I've been talking, I know I saw a news broadcast where they asked him, do you think there's going to be a reset? He says, I'd really hate to say anything like that or even comment on it. But he says sometimes the economy needs to reset. We're making some changes. And, if you go back, even 2 years ago, we started the downward cycle. That was a normal economic cycle that needed a reset. That's what it does. And the cycles never go without completing. So far in history, they've always completed. I've been saying that for a couple of years. That doesn't mean the market hasn't gone up. It's been manipulated really quite nicely. I mean, the Fed's done everything from pump money backdoor to the banks to get them to be able to buy stocks. They've loaned them money to cover the defaulting loans during the COVID era, and they were supposed to pay them back last year. They didn't pay them back. They basically get to continually not declare those losses. They're called unrealized losses. I mean, no other accounting firm could do that for their clients, but banks can account that way because the Fed lets them, because the Fed's not a government agency. The Fed's, in cahoots with the banks. They are the banks, and they're trying to make it look like the economy is good. Even last year, the Fed did something. I don't understand how the Fed can be in charge of this, but they allowed, or maybe it was, they had to be in line with the government right before the election. They didn't want anything to rock the boat, but there's the highest delinquencies on mortgages ever, like over 1 million mortgages are delinquent. 300,000 of them were in bad default, but then they ended up restructuring the debt, giving them an incentive to pay their mortgage and lower their debt if they would keep them current so that they didn't have to declare all these mortgage defaults before the election. So, there's been a lot of things that have kind of kicked that can down the road, stretched the balloon a little bit bigger. The bubble's just getting bigger and bigger, and there's more bubbles that are getting bigger and bigger. We have the highest default rate on mortgages, although they're not being propped up. Now everybody's got to own up to their debt. We're not bailing everybody out like we were before. So, if there is going to be a recession and a reset, it is more likely going to happen now than later, and it's going to happen more likely now than last year or the year before. In retrospect, we see all the gamesmanship that was being played by the Fed and the fact that the Fed's out of money, yet they're still faking loans and bond purchases to banks and then faking buying them and then paying interest on money that they loan them. Talk about Ponzi scheme, but it's okay because it's the Fed and we want the market to look good and we don't want people to be worried. And, otherwise the economy will go into a tailspin and people get scared, and that's not good for the economy. And to a degree, I agree with that. We don't want to scream fire. We just want to quickly be the first one out of the building, rather than be trampled by everybody when everybody knows. But the bottom line is eventually there's going to be a recession. There's going to be a reset. The yield curve uninverted in January. Recessions have always happened after the yield curve inverts 1 to 2 quarters later and after at least 2 interest rate reductions. We had 3 over the last 6 months or so, since September last year. So that's been 6 months. We basically set the stage for that next reset. The other thing that makes a recession actually a good thing, and I hate to say that, but right now, there's so much inflationary pressures, and even tariffs are considered inflationary because companies that import goods are going to be affected by tariffs. Either the other country is going to retaliate and raise tariffs, so exporters are going to have a harder time selling their goods. Possibly, they might have to lower prices on our end in order to accommodate the tariffs, which means profits might not be as good. We also have companies that import stuff, even parts for what they make here. If there is any manufacturing left here, I know so much of it is left in the last few years that we've got to bring all that back, and we're going to do that based on tariffs, but it's going to take some some time. In the meantime, exporters are going to be making a little bit less because they've got to accommodate the other end tariffs. Importers are going to accommodate the tariffs that we're charging on those goods. And again, it's not on the entire retail price of the good. I had a guy come into the store and talk about how, oh my gosh, these avocados are 70 cents. So just see what they're going to be with those tariffs, probably be double by next month. No, if a Mexican avocado farmer sells an avocado for 10 cents, and the tariff is 20% or raised by 20 or 25%, then it's now a 12-cent avocado. The transportation is going to be the same and probably less if gas prices go down. And if Walmart, still is okay making 10 cents on the back end, if they don't need to make 12 too, then okay, the avocado goes up to 72.5 cents or maybe 75 cents. I mean, is that going to be a make or break deal? Not necessarily, but if a California farmer can't sell an avocado for 10 cents and make money, but they could sell an avocado for 12 cents and make money because they've got a million of them and that will accommodate their overhead, then now all of a sudden California avocado farmers get to be in the mix, but that takes a while. So the immediate effect is like a big slap in the head going like, oh my gosh, everything's going up. It's inflationary and everybody kind of recoils and gets worried and maybe have to spend a little bit extra money, maybe go into a recession. But here's the other thing that happens is, if inflation continues to get out of control, and it started out of control again just because the Fed was basically not fighting inflation anymore because they wanted to accommodate the regime in power for the election. They didn't do anything to really keep inflation in check. And we've noticed that those inflation numbers are going up again. And of course, they're blaming Trump for it because, of course, everything's a couple of months, 2, 3, 4 month lag. So he's feeling the brunt of it. The thing is how do you combat inflation? You have to raise interest rates. That's not good in this market, right? We're already having some struggles. Stock market's being fidgety. People are already spending too much on eggs and everything else. Gas prices haven't fallen to the floor yet like they will eventually when we become energy independent. So there's a lot of things that we're waiting on and there's a lot of stress in the market. But here's the other thing that we have to realize is there's $7 trillion in debt that has to be paid off this year, or not paid off, or refinanced this year of the 35 trillion or whatever it is that the national debt is now. 7 trillion of it needs to be refinanced this year. And right now the interest rates are over 4%, 4.5%, 4.25%, something like that. So changing a little bit every day, but slightly going down, and they're kind of forcing them down. The best way to get them down farther would be to have a recession and be in a position where we actually do have a reversal in the inflation. We do actually have a little bit of deflation. We have so much lack of demand and people scared enough that they're not buying things, and all of a sudden prices get reset. The recession is good. It'll get things actually back to normal value. What if we had interest rates go from 4.5% down to 2.5% by the end of the year? Think of the billions and billions and billions and billions of dollars that would be saved just on interest on servicing that national debt. So yeah, it might hit. We all might have to suffer the brunt of a little bit of a pullback and a tightening of the belt with our budgets. Maybe we just don't buy a few of those frivolous expenditures that we are so lucky to be able to do generally in America, the land of the free and the land of the abundance and unlimited abundance if you work hard enough for it. But there might be a recession. I think it needs to happen. And it wouldn't surprise me if the economists and Donald Trump and everybody in charge know that as they get this thing in order, they'd rather have a recession sooner than later. It's still close enough to Biden to have us remember that the inflation really started there and some of these problems started there and were exacerbated by some of the Fed games, that in a year or two, it could be passed off as, well, that was just fixing the Biden problem. Now look, the economy's better off. But if we don't go into a recession soon, it's just stretching that balloon higher. The bubble's getting more full of hot air and fake stuff, and it's just going to pop harder and louder. The fall's going to be greater the longer we wait to have that reset. The economy, if you look at economic cycles, and I've said this so many times, they always go back to normal. Prices always go back to equilibrium. The average price earnings ratio of current price earnings, the trailing price earnings, meaning look at the last 12 months of actual earnings, is about 38. Well, it was a week or two ago before the market started selling off. But on the S&P 500, the normal range is like 15 to 17. So the market essentially is valued at twice as high based on earnings as it typically is, or historically we would call fair value. In a crash, it typically dips below fair value. So that means there's 50 to 70% in potential market sell-off if we get back to those original levels. And I'm not trying to be Chicken Little calling the sky is falling and all that stuff. We've got to realize that things have been overvalued. Prices are finally going to get back to normal. Maybe somebody can finally afford a house after this. Maybe you can afford bread and eggs and those things that, our families depend on without getting that second or third job. The middle class can thrive again, but it may take a little bit of pain to get there. The thing that people don't acknowledge is inflation helps rich people, because rich people have all the stuff. They have stocks, they have houses, they have collectible art, they have all kinds of things that in an inflationary environment go up in value. Their net worths continue to increase. But in an inflationary or a high interest rate environment, the middle class has to borrow at higher interest rates so they can pay less for stuff or buy less stuff. They don't have as much in the stock market. They don't have multiple properties in multiple states all around the place to take advantage of this real estate appreciation. They might have a house, house, but they're not going to move out of the house. And if they do, they just have to buy another house of equal value or higher value. So the economy and inflation and higher interest rates and the great market has not really helped the middle class. And I believe Trump is more of a middle class guy, and he may be willing to take it on the chin himself as a rich person. Elon Musk is a rich person. By the way, they're not stealing our money. They're trying to put spending it unwisely. I can't believe the narrative on the other side. But anyway, well, that's another question. But bottom line is, I do think that we need a recession. We have to get to reset to normal value where everything can be sane again, and there can be actually free trade, free market, capitalism at work, rather than market manipulation by the Fed and banks that are pretending nothing is wrong. When the Fed comes out saying, well, I think the economy is actually pretty good. Just recently, I was listening to some recordings of Jamie Dimon and the Fed talking back around the election time and how their voices kind of shaky and they didn't really seem like they were speaking with conviction while they were talking about how good the economy was and the consumer could afford things. And because in their head, they knew that they couldn't. I didn't know about all this gamesmanship with the mortgages and the defaults and the incentive to keep paying your mortgage, and they'd lower the mortgage if you just not default right now because there's an election coming up and all that kind of a thing. That's the stuff that the media hides and the government's not going to tell you about, but that we always seem to find out later just by all the things that Doge is finding out later. Is peel back the layers of the onion and see what's really inside. And we're doing that right now. And I think as those things come to light, it wouldn't surprise me if there's a recession. It may be fairly hard. I don't think America's going to melt down and we're going to go out of business and the dollar's going to be devalued to where we're not even a force in the world. I think we'll still be the country of choice for investments and the country of choice for government bonds and the country of choice for currency and all those other things. However, I do think there's a reset coming. And I've said that for a couple of years. I'm not a doom and gloomer. I'm a realist that knows history and knows that these things always happen. And every time they happen, before they happen, there's all the people that are saying it's different this time. No, why are they being doom and gloom? The market always goes up. It always comes back. And it does. But it always cycles too. So let's just get a glimpse of reality. There are sectors in the market and even sectors globally that are doing very well. The market in America is so overvalued that the markets in Europe and mostly around the world are undervalued comparatively speaking. And so if there's a sell-off here, there's money to be made elsewhere. We can buy ETFs in Europe and Italy and doing great right now, and Spain and Germany. When have you heard about their economy doing great? All we've heard is the global meltdown, but there's some economies that are actually getting back to fair value because they've been undervalued. Well, there's opportunities there too. We don't have to just say, oh my gosh, Wall Street's, in trouble right now. There's, I'm going to die. My money's going to go worthless. No, there's different ways to make money. Money's fluid. There's also different ways to save money and not lose it. And that's what we provide advice on is, if there's going to be a reset, let's not lose it. And if I'm wrong and there isn't a reset for a couple of years, like there hasn't been for the last couple of years, guess what? We're still making money on our indexed products, and we're still making money on our low and no risk portfolio that's being managed in a very low to no risk asset allocation. Okay, so we didn't make 29% on our risk market. We didn't lose 50% either if it would have crashed. And we're better off now than we were last year. Don't worry about a recession. If your money's positioned right and you've prepared for the recession, which we've been doing, and we prepare for all recessions, there's probably going to be a few more. Guess what? The plans we do today are preparing for the next 4 recessions that you're going to have in the next 30 or 40 years, because that's how long retirement might last you. So let's just be smart. I'm not saying that we're market timers. I'm just saying when the odds are against us, let's not fight the odds. Let's not go into danger zone with scared money that we can't afford to lose and put it out at risk. Let's monitor those risks. And let's be smart about where we park our money in the meantime.
We're talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about current events, in particular the market and the economy, how things are doing under Trump. And if you are listening to the conversation today, Jeff's thoughts resonate with you, you'd like to get in and sit down and talk with him about your portfolio, how it's positioned for what may be coming down the pike, give us a call right now at 520-780-9059 to request your no-cost, no-obligation, no judgment Premier Retirement Roadmap. Again, 520-780-9059. All you've got to do is call, leave your name, telephone number, say, Shelley, call me back, and set up an appointment so that I can come in and sit down with Jeff. No cost, no obligation for this, certainly, and there is no judgment. We'll meet you where you are. 520-780-9059. You can also find out more about us online at premret.com, PREMRET.com. We talked about rate cuts a lot in this program, Jeff. Do you believe that we're going to have any more rate cuts or possibly maybe even rate hikes here in the near future?
We're already getting a rate hike based on the fact that the Fed's selling bonds, meaning that they're taking the money out of the economy. And when you sell bonds, you basically drive the price down. If the price of a bond goes down, the equivalent interest goes up. So the 10-year yield has gone up. It actually hit 5. It came back off that just a little bit. The 20-year bond actually is up. I think it's 4.8 right now, and might be easing up a little bit. I know Trump really wants to lower interest rates because it will help the economy. We have to watch out about how that might affect inflation. And really, lower interest rates don't actually create inflation if there is adequate supply. And what has to happen in order to make this rate cut feasible and actually a benefit, you could lower rates and have people able to buy a house with a 4% mortgage, but if the house goes up $200,000 before they buy it because of inflation, that's not a good thing, or because of the limited supply. So if we can get manufacturing back intact here in the U.S. and have all the sectors in the economy pumping and moving and shaking, and we have foreign countries that don't want to pay tariffs on their goods, actually build factories here and build stuff here, our economy gets better. We have better supply. We have quicker access to that supply. And if we have supply, tax cuts, interest rate cuts, all those things that create more money flow don't have to increase inflation. The only reason it increased inflation is because, they shut down America and they shut down the world with COVID. They got a supply chain back up, but nobody's ever able to recover. The last administration slapped so many restrictions and regulations on companies, they didn't even want to get into business. Then they threatened raising taxes. Nobody wanted to do business. Nobody wanted to create that supply. I think that those days are over. I mean, there's a lot of people that want to get back into business, want to get back into manufacturing. Foreign companies or companies that are based here, but doing a lot of their operations in foreign countries because labor is cheaper. Shoot, if they've got to bring that stuff back here and pay a tariff on it, they're going to just bring that business home. So I see this whole situation shaking out over time. I don't think it can be a quick fix in a month or two. In fact, if we look back at the history of Ronald Reagan, he came in and, he came off of a period of stagflation, just like we come off of the Biden administration, where inflation's out of control. People aren't very happy. People are having to work two jobs. Not a gas shortage like there was back in the Carter era, but there is certainly high-priced gas. We can get all we want. We just need to. They've used up all the strategic reserves, and they've, made gas prices so high that everything else costs more too. So if we can get all that under control, we may still have to go through a little recession before it happens. But I think the outlook is really good. And I think that we'll be able to create the economic structure to where rate cuts are not going to cause inflation like everybody's fearing. I think the rate cuts will be a good thing, but I think they have to be done, carefully. And we've essentially have been having rate hikes, even though the Fed says they lowered interest rates for the last 3 different times to a total of 100 basis points. Had 3 interest rate cuts last year, but they were only on the short-term interest rate. All that did was help them pay short-term interest on some of their debt and, kind of refinance stuff with banks and kind of do their little insider backdoor games with the banking system, because banks and the Fed are basically one and the same. They're partners. They manipulate together. And they're really not a government agency. All they're there for is to make the banks look strong so that we don't freak out and go have a bank run and, cause 1929 again. So they're playing some, fun games. They don't even have to write off their debt and call it losses. They can just basically hand those loans over to the Fed. The Fed can hold them for them and say, well, they're unrealized losses. We don't have to realize them. We're not going to count them on the books because someday we'll have to give them back to you and you'll have to finally count them, but not yet. We're going to continue to pretend that you're making money, not losing money on all these, bad real estate loans and things that happened during COVID that, banks are taking a bath on. But the taxpayers basically are funding that with tax money and the Fed playing their game. So if the interest rates do go down and the Fed stops playing games, I don't know if they're going to have those books reconciled with all that, bad commercial debt that's supposed to be bought back and, some of these things that are kind of left out there in the wings. I don't know if that's going to get fixed, during Trump's term. I think, a good business planning would say, yeah, that should take place. But, again, we don't want to rock the world by causing a banking crisis either. So, it remains to be seen. But I think the goal is to have interest rates lowered so that people can buy things. And as long as there's not inflation, that's a good thing. But honestly, I'd rather have housing prices stay where they are and have interest rates go up than have housing double and have interest rates go down a little bit, because it turns out to be just as prohibitive to buy if they both don't go down together. In other words, lower interest rates keeping things the same, or even have some sort of a recession that would reset the pricing of houses and some of these overpriced goods that people are, especially rich people are willing to pay for because they can. But middle class and poor people can't even get close to it. It'd be really nice to have them participate in the economy again. And I don't think they have for, a decade or so.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about investment opportunities and risks here in 2025. If you've got questions of Jeff, once again, our telephone number, 520-780-9059. That's also the number that you can use if you'd like to get in and sit down and talk with Jeff on a one-on-one basis, talk about your individual situation and maybe what your next move should be for 2025, the things you should watch out for. Again, 520-780-9059. Make that call this weekend. Leave your name, telephone number, and Shelley will call you back during the week and set up a time for you to come in and sit down with Jeff. Again, this is just a casual conversation. You don't need to bring your tax forms, anything like that. And again, there is no cost Absolutely no obligation. It's a chance for us to get to know you. You get to know us and determine whether or not we're a good fit. 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, in looking at our portfolio and preparing for 2025, what are some of the things that we should concentrate on, some of the things that we should be looking at?
Well, I think a big one is rebalancing a portfolio. There's people that have had, NVIDIA, let's just say, for 10 years in their portfolio, and now it makes up 80% position, but they don't want to get out because it's still making money. Well, it probably is, but it still doesn't hurt if NVIDIA ends up, finding out that there's another competitor in town besides this DeepSeek that came out and, dropped NVIDIA 20%. I mean, what if you have $1 million and 800,000 of it is in NVIDIA, and in one day you lose $160,000 on one position? And what if that situation is real, where NVIDIA's maybe peaked and their growth isn't going to be as strong because now you've got AMD and Micron and all these other big companies, TSM, Taiwan Semiconductor, and some of these other companies that are creating fast chips, and some Chinese companies that are getting into the market. So what happens if all of a sudden they become less than ideal as far as their growth or their status in the marketplace? So you don't want to be overly invested. There's another one I just talked about earlier that went up 400% in the last few years. Rebalance those. Maybe take half of that off the table and redeploy those into new up and comers that are following behind it. There's a couple of other competing companies with that company that are kind of in the same space. One of which I know has a price earnings ratio of about 30, and it's doubled in price in the last year. This other one's gone up 4 times in the last year, but it's got a price earnings of almost over 500. I mean, I'd rather take the one that has a little bit more of a fundamental and is actually growing earnings at 3 or 4 times the clip than the one that's overpriced. So, rethink your exposure to things that have gone up that might be kind of exhausted as far as their run goes. I would also caution people to remember that stocks and bonds are not necessarily, hedges with each other. Stocks can go down, bonds can go down. Most people that are in bond portfolios are still down, and they wonder why their portfolio has not been growing. Is because as interest rates have had to go up to fight inflation, and even though the Fed says they lowered interest rates, bonds have continued to drop in price. 20-year bonds down over 20%, the 25-year bonds over 30. The aggregate bond portfolio is still down over 10 or 15 from when it peaked a few years ago. So if you're still holding on to bonds, either write them out or just, consider, is there going to continue to be increases in interest? If so, your bonds are probably going to lose money. If, however, you got out of bonds because they lost money, and you think, and I'm leaning this way too, and I'm still waiting to see it play out. But, if Trump gets the supply chain kind of figured out, the economics rolling, and he, puts enough pressure on interest rates, or if we go into a recession where people do, fly to what they consider as more of a safe play in bonds, the price of bonds will actually go up, which means interest rates will go down. Or if interest rates go down, it typically does reflect in an upswing in bonds. So we might want to consider reallocating into the bond market this year as we see those interest rates stabilize and even start coming down. So that's another thing to consider, especially if you got scared out of bonds from earlier. If you're still kind of just riding them out, well, just don't be upset because your portfolio is still down. That part of it may come back if interest rates go down. But again, if inflation continues to be a problem and bonds continue to fall because inflation is a problem, interest rates typically are kind of forced to go up. And if that's the case, your bonds are not going to be that safe haven you thought. Consider some alternatives. I think gold and silver has always been used as a hedge. I think not so much as a hedge, but I think it's a viable asset class now just to include in a growth portfolio. I think the trajectory of gold and silver and precious metals is something that a lot of people think, well, I only have a few coins in my safe in case the world comes to an end and I need to trade it for bread and food with my neighbors or whatever. I don't think that's necessarily a bad idea to have a little bit of gold and silver if that's, your thing and you want to be prepared for whatever could happen. But you can buy gold and be exposed to gold through ETF, exchange traded funds. I am not a proponent of buying it through those IRA things where they have actual physical gold where you have to pay a big commission going in, big commission going out. Those are gold and silver brokers and they rip you off. So you can play gold and silver through Wall Street, through ETFs, exchange traded funds with virtually no cost, get in and out of them at any time. It's liquid. So there's some things, consider your bond holdings, consider rebalancing, especially those positions you have large exposure to. Don't get out of them. Just dial back, take your profits off the table so that if something does happen, you always locked in a big gain. You can never get hurt taking a profit. And that's one of the old adages that I learned when I was a stockbroker is the only people that didn't get hurt, in the 87 crash was those people that took some profits before that happened. The only people that didn't get, hurt in the 2000 crashes, those that kept taking the profits off the table during that late 90s run when the dot-coms were going crazy. Same thing with the 08 crash. Same thing with any of the corrections of late. If you keep taking profits off the table and park it in a safe place, that's money you don't have to worry about losing. That's money you can rely on down the road when you need income or when you have an emergency come up where you need the cash.
If our conversation has piqued your interest today, call us to request your Premier Retirement Roadmap, 520-780-9059. No cost, no obligation, 520-780-9059. Jeff, time for a break. When we come back on Premier Retirement, we're going to answer listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
Welcome back to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management in Tucson and also up in Mesa. My name's Jeff Shade. Glad you could join us again this week. We're here for you every week for your fiscal fitness and your financial education here on 790 KNST, Tucson's most stimulating talk. And we're on several times a week for you. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. If you've missed any part of our program, you can't join us during those times. Remember, we're also a podcast. Go to wherever you get great podcasts and search for Premier Retirement with Jeff Hogan. You'll find the show and many of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, let's dive in right here. The second half of the show, we always start it with listener questions, and Jake is up next. Jake's listening to us in Tucson, and Jake writes, I'm 42, married with 2 kids aged 10 and 13. My household income's about $110,000. My mother just passed away recently, leaving me $2.2 million in stocks, bonds, and cash. I use $75,000 to pay off debts, including 2 cars. I also still have $200,000 left on my mortgage. Should I pay that off? If so, then how should I start to invest the remaining $1.9 million?
Well, that's a great question. Now, I'm sorry to hear about your mom and her passing, but the good thing about inheritances are they get a step-up basis tax-wise, unless you have some annuities and things like that, or IRA money that, I don't really know the breakdown of this. If there's IRA money and things like that, you might have a different tax situation, but I don't think it's a big deal whether you pay the house off or not, unless it gives you the peace of mind that you need. There's obviously plenty of money in there to do that, but I think over the next 20 years, let's just say you're 42, you have kids, you're probably going to work another 20 years, I'm guessing. I mean, you're not going to just say, I got $2 million, let's just retire. I mean, I suppose you could. You'd have to, build a plan that created guaranteed income, at least to Social Security age, and you wouldn't get a whole lot of that because you're not working for the next 20 years. So I'm going to assume you're going to keep working. You've got, young children that probably need to go to college in a few years if you want to do that kind of a thing, or trade school or something, learn a skill that, they can be self-sufficient with. Again, it's just kind of, if you want to pay off the house, great. If you have a 2% mortgage, honestly, I think it's silly because you can make more money on your money than you can paying it off. But again, if it's a value thing where you like to have a free house and, you listen to your grandpa or people old school that used to say pay off your mortgage. Well, that was probably when mortgages were 7 or 8 or 10% in interest. And if that's the case, I think if you have anything higher than about a 4 or 5% mortgage, you ought to just pay it off. It's easy just not to have that payment, and then all your cash flow is all your cash flow to spend. You don't have to be saddled to a mortgage, other than the taxes and insurance and any improvements you have to make along the way, obviously. So how should you invest it? Well, I don't know. I'd consider a few different things. Let's say half of it's IRA and half of it's not. Let's say you've got, and I'm just going to round the numbers to millions. So let's say you have $1 million in IRA money. And in my opinion, if it's an inherited IRA or something like that, you've got 10 years to pull that money out and pay taxes on it. So you can think of it 2 ways. You can kind of wait till the next correction and try to cash it in when the market's low and do some tax loss planning that way, or you could take it out over $100,000 a year for the next 10 years and just, see how that goes. You could even annuitize it to where you get a guaranteed rate of return and a guaranteed interest, a guaranteed payment, and you would know exactly what your taxable income is going to be. So there's ways to control that if there's, that 10-year payout, forced on you with IRA money. Let's just say the other $1 million is money that you could put in stocks, bonds, and cash or some cash equivalents. Well, the ones that generate interest or mutual funds that generate 1099s every year are going to give you kind of a surprise tax bill every year. So I like tax efficient planning for my non-IRA money. In fact, I would have you consider that for the money that you're going to have paid taxes on if there are some, IRA type funds from your mom. Once you've paid taxes on the money, it really stinks to have to keep paying taxes over and over again on the gains and stuff. I really like tax efficient products, especially while you're working, probably in a reasonably good income, at a good income level, probably in I don't know, 22 or 24 bracket now, I'm guessing. You don't want to go into a 30 tax bracket if you don't have to. So you have to consider what you're going to have to take out over the next 10 years tax-wise, and what you're going to make, whether it's a known increase or a surprise increase based on the type of investments that you make, based on any trades that you might make. So I would consider that whatever you do to try to look at it from a tax perspective and make sure that you can stay in the lowest tax bracket possible while you divest some of that investments that you're in your mom's estate that she's left you that you're going to need. So I would look to LIRPs, life insurance retirement plans. Here's a couple of reasons that works great for a person your age is, 10 years down the road. Let's say you took $100,000 plus gains. Let's say it was $120,000 a year for the next 10 years out of half of that money. And you put it into a LIRP. First of all, that LIRP would end up generating $200,000 or $300,000 a year tax-free cash flow to you when you decided to finally retire. So that would be nice to retire with tax-free money and only have to pay tax on your Social Security, or maybe not pay tax at all and live like a king. The other thing it gives you is a place that you can borrow without going into a higher tax bracket. You can actually borrow from a death benefit, which is tax-free, to send your kids to college, for example. You get a double tax break that way. And what I mean by that is, let's say you got $1 million in this LIRP, or you say you got $1.2 million, but it's worth $1.5 million. And so if from a traditional investment, if you took $100,000 out to send one of your kids to a nice college, I'm sure it's going to cost at least that by the time they get there. You end up having to pay tax on the gains. Well, not with a LIRP. With a LIRP, you can actually borrow the $100,000. You can write checks to bookstore tuition, or the stuff that you pay direct could possibly be a tax write-off. So you actually get a write-off against the income that you make from working. Yet you don't have to pay tax on the money you take out of the LIRP because you've already either paid taxes on it or your mom did because you inherited it, got a step up in basis, and now you put it in this tax-free, basically a self-directed bank. It's kind of like having your own tax-free bank. That's, I guess, the best way to describe a LIRP. Life insurance retirement plans. You use life insurance because it creates a tax-free death benefit, but you use the tax code in order to never pay tax on the money you use from it. When you die, the rest of whatever's in that account ends up passing to your heirs tax-free. You may have some tax problems or tax liability with what you just inherited from your mom, but what if you could give your kids an equal amount or more, and it would all be tax-free, and there would be no restrictions on how fast they have to pull it out, how much taxes they have to pay on it, et cetera, et cetera. No deferred taxes. This is already taxed money. So once you set it up in a LIRP, it's your flexible bank account that you can use as you want to. You can use as much or as little as you want to, and whatever's left in there when you pass away goes to your heirs, to your spouse or your heirs, if it would be on your life. So anyway, that's where I would start, is look at your tax efficient distribution and redeploying those assets into some tax efficient retirement planning assets. And again, if you also have another $1 million that you want in growth assets, I would use ETFs, exchange traded funds, if you wanted to do more of a diversified sector type investment option that would not create a tax burden every year. That would only create a tax burden when you sell those assets. You would only pay at that point capital gains tax on the gains at that time. So there are ways to get the growth that you want. There are ways to get the safety that you may want, and some tax breaks along the way as well.
Jake, thank you so much for listening to us in Tucson. We appreciate you sending us this question. And of course, you'll be getting Jeff's book, Retirement, The Road Ahead. Jeff, our next question comes from Randy in Oro Valley, and Randy says, I'm 67, have about $1.7 million in various assets, excluding my home, which is paid for. I'm in the market for a new financial advisor. I've interviewed 3 so far, and I'm finding that some advisors use an outside firm to manage their money for them. How important is it for an advisor to manage money in-house, or does it even make a difference?
Well, it may make a difference. It may not make a difference. Here's what I've found in this industry, and I really like what I do as far as the interaction that I have with my clients. I sit in meetings most of the day. I really like it. It's like the premier family. It really is. And I enjoy meeting with clients. I don't have time, although I do day trade and play around on the side, and I do my own little things. And sometimes I'm so busy in meetings that I miss stuff. But I don't do that for clients. So let's just say you could either be really good at trading and managing money in-house, or you could be really good at building plans and helping people save taxes and feel confident that they're not going to run out of money, and using the right asset mixes between annuities, LIRPs, indexed products, tax-efficient products, ETFs, mutual funds, stocks, bonds, whatever it is, and create some sort of an income plan for it. That's kind of where I thrive and I really like to do. So honestly, I don't really like the pressure that I have of watching stocks and sitting glued to the ticker tape all day to make sure we're in and out of the right type of assets. So sometimes there's in-house management, and I would say that if it is done in-house, it's probably passive anyway. It's just, we're just going to stick it in the S&P hear the cues and, see what happens. And, this is our risk money, so let's just not even worry about it. But then there's other asset managers that do watch it every day, that they do make trades when a stock becomes out of favor or they find out comes with bad earnings and a bad outlook. I mean, Tesla's one that has been in favor in the past and it's not really in favor right now. If we had a lot of assets and we didn't look at them very often or trade them on a regular basis, maybe we'd be in that type of a stock too long. And I'm just naming some things. I'm not saying sell Tesla short or that it's a crappy stock. It's a good company, but I mean, it's kind of finding its way right now. So there are managers that we can split our fees with where they do the heavy lifting from the standpoint of all the nerdy stuff like the quant analysis. And I think it's an asset to have good managers that are really focused on that. Now, they probably couldn't talk to you in a level that you could maybe understand what they're doing because their minds work a different way. I think I have the ability to kind of explain in layman's terms, how these things work and why we do certain things. But, to try to explain to you, the different coefficients and ratios and, quantitative analysis terminology of some of these guys that are really focused on building portfolios and managing money in an effective way or using hedges and things that sometimes have to be, looked at and maneuvered on a day-to-day basis. Unless I was to hire them in-house, which would be at probably at a price that would cause my fees to have to be higher than they otherwise are. It's easier for me to go to somebody with economies of scale that's already managing $1 billion for several small offices like me, pool our business and let them do that kind of work. So I would venture to guess that the in-house managers, although it might sound really cool, my guy does this, may not be as attentive if they're visiting with clients and having other duties, or if they just like to golf with a client once in a while, that they're not going to have that hands-on focus that you might want. So I don't think there's a problem with using outside managers. We do. There's also some things that you can get through outside managers that you can't get on your own. I cannot build because I'm a small regional firm. I mean, I'm large compared to many of the independent offices, but I'm not Merrill Lynch. I can't pool $1 billion with my clients and start a private equity fund, but I can access with tens of millions of dollars of my of certain clients' money that's more appropriate for, and build a pool and join with other independent offices. And we can create a portfolio where we can actually access a private equity manager where they make, short-term loans and real estate investments, things that you really can't do on Wall Street, or it doesn't have anything to do with stocks and bonds, but those can be in many ways a lot more stable. Rich people, billionaires use these hedge funds and private equity managers all the time. But most of our clients are, have a few million here and there, but, are not billionaires to where they have their own personal hedge fund manager, in-house. So we do have access to outside investments that, a lot of these firms may or may not have, but I wouldn't say that would be a deal killer either way. I think you just need to find out what you want. If you want somebody in-house that you can say, hey, why did you buy Tesla, or why did you sell Amazon, or, why are my stocks this way and why have we held on to these things, and they can answer for you because you really want to be involved in those investment decisions, then choose somebody that does it in-house. But if you want a comprehensive plan that has certain assets that, are managed to try to hedge against the downside and risk, I mean, for example, if the market goes down 20 and you only lose 10, but the market goes up 30 and you make 20 of it, and yet in the overall scheme of things, it ends up in the same place 10 years from now on, would you like an outside manager that used some hedging techniques that could do that for you so that the downs aren't quite as gut achy, but the ups are still reasonable enough to make you happy in the long term? Those are some of the choices that you have to make. And, you might have an independent agent that's really good at that. I don't know very many, at least in this town, to be honest with you. Most people do use outside firms or some sort of an asset allocation strategy that is really more passive, or at least given if it is active management, it's handed off.
Randy, hope Jeff's answer helps you make that choice, and we appreciate you listening to us in the Valley of the Gold, Oro Valley. Next question, Jeff, is Grant listening to us in Rita Ranch, and he says, I have a Social Security claiming question. My wife and I are healthy 58-year-olds who plan to retire at age 60 and not work in retirement. Our new planner says we should take our Social Security at 62 and keep our 457 plans invested 60-40 for another 15 years, taking RMDs at 72. His thinking is that we can't get the Social Security money back. It goes away after we die, and the benefits will likely be reduced, taxed, or stopped. What do you think of this? I've also heard that we should wait as long as possible to claim, as long as we can afford it.
Well, honestly, I used to be kind of, my old school idea was wait as long as you can and take it when there's more. little bit more skeptical of that just based on the health or the lack thereof of the Social Security Trust Fund. And just knowing that, every option on the table is to raise taxes or to decrease benefits to those people who have stuff, who have been responsible in favor of those who have not. So I think there might be a shift in what you get from Social Security. So I am with this guy you're talking to as far as taking Social Security early. However, it depends. I mean, if all you have is a 457 plan and, Social Security, and that's going to make ends meet, I don't know how much you have in there. You have a couple $1 million in there. Is it $400,000 or $500,000? You have a pension from some other job. 457s are typically with first responders. So maybe you're a fireman or a policeman or government worker. I mean, if so, thank you for your service. And, hope you have that type of a plan. But you also have deferred comp, which is deferred compensation in the 457, which means you withheld some of your income so that you could have a nice little retirement plan in the future. You can roll a deferred comp. Once you retire, you can roll a deferred comp 457 plan to other IRAs. Now, I hope this advisor only started there. I mean, it doesn't sound like a very comprehensive plan. Our new planner says we should take. Well, I don't know if that planner, people call themselves planners. All they do is say, 60-40 stocks and bonds and just park it there and wait 15 years. And then they charge you a fee for that. That doesn't sound like a plan to me. I think in addition to that, you need to look at your tax plan and find out why you're taking Social Security early at age 62, and you bridge that gap with some of your savings, obviously, between 60 and 62. But are you also in a low enough tax bracket where it would make sense to do some Roth conversions or even divest that 457 over the next 5 to 7 years and put it into a LERP so that instead of having to take the required minimum distributions when you're 73 or, in this case at your age, it's going to be 75, I think by then, 2033, I believe it is going to be age 75. So you don't have to take that money out for a long time, but if you can live on Social Security and not take any out, great. But if you have a pension that's going to start, at age 60, great. Maybe you make ends meet. But what I would do is I would maximize whatever tax bracket you're in, keep paying tax at whatever the tax bracket you're in, take as much of that IRA or 457 money out. I'd convert it to an IRA. That way you're in control either to a Roth or to do LERPs with that. That would create a situation where you don't have to take the money out when you're 73. You can continue to live on, the income you're used to living on, take money out on a tax-free basis every time you need an extra chunk of money, like to buy a car, go on a trip or do whatever, or help a kid through college or, give it to a grandkid for graduation, whatever. But I think the tax plan here, wasn't addressed. It needs to be, the income plan needs to be addressed. And I think redirecting that 457 into a better mix, a more comprehensive tax efficient plan would make more sense. So if you're not talking comprehensive, come on in and we'll talk comprehensive with you and maybe make your good plan a really good plan.
All right, Grant, thanks so much for listening to us in Oro Valley. We do appreciate that question, and of course, we'll send you out Jeff's book, Retirement: The Road Ahead. If you've got a question you'd like us to answer on the air, you can get it to us a couple different ways, one of which is you can call it in to Shelley. She'll take it down, 520-780-9059, 520-780-9059, or better yet, I think the best way to get it to us is to go out to our website, which is premret.com, premret.com. Use the contact page there, send it to us, and again, if we use it on the air, we'll send you out Jeff's book, Retirement: The Road Ahead. You're listening to Premier Retirement with Jeff Hogan. Once again, use that telephone number that I've just said to you in order to get your no-cost, no-obligation retirement roadmap, 520-780-9059. Again, it is just a casual conversation with Jeff to get your questions answered. Again, not going to sell you anything in this consultation. It's sort of like a public service. It's a chance to sit down one-on-one with Jeff, get the questions answered that you need to have answered to put you on a path towards a confident retirement. Once again, it's the retirement review, sort of the retirement roadmap, if you will, 520-780-9059 or online at premret.com, premret.com. Jeff, we've talked in the show so many times about people getting this retirement roadmap, and I thought I might take the next few minutes of our program here just to let people know what that is. It's actually a 5-point retirement review. Can you go into more detail about what those 5 points are?
Well, it is. We call them the pillars of planning. We use pillars in our imagery of our company a lot. It's, what holds up the overall plan, right? The first pillar is, protecting what you've worked a lifetime to achieve. What kind of investments are you going to make that protect principal and don't go down? How do you turn that investment philosophy, that new investment philosophy, because it's not usually the one most people are prescribing to prior to retirement. It's all about growth. It's all about dollar cost averaging into the market. And I think that's smart. But I think you need to consider, how much can you afford to lose and not put money in the market that you might need for your bills individuals at risk. So we want to focus on that. And the reason we want to focus on those investments and the protection of those investments is because much of that will likely be needed for income. So the next phase would be our income phase. What income are you getting that's guaranteed right now? Social Security? How much Social Security? Did you get some sort of a pension offset or a windfall exemption or some sort of a thing that would, maybe impede your ability to collect all of your Social Security? Or when should you take the Social Security? And once we've got that figured out, do you have pensions or other income guarantees that will help bridge the gap between what Social Security pays for and what you want to live on as far as your minimum, your minimum lifestyle needs? Maybe you've got $1 million or a couple $1 million in IRAs and other funds that you want to try to not use until you're 73 or old enough to take required minimum distributions. You want to spend all your savings now. Well, in my opinion, that would be a mistake, because all you're doing is kicking the tax can down the road and probably going to force yourself into a higher tax bracket. So you'll pay more taxes on more money at a higher rate later rather than paying it now. So again, we look at the income. What's the most efficient way to use the savings that are going to be taxed? Do we need to convert some of that savings into tax-free money through Roth conversions or life insurance type programs? Or even an annuity that pays principal plus interest, so you know what your tax bracket is going to be for the next 5, 7, or 10 years. We can ladder those investments to create guaranteed income or predictable income, depending on if you want to take a little bit of risk, but we want to minimize the risk as much as possible. So, looking at the investments, they have to correlate with that income plan. So there's the investment pillar. There's, what's the allocation? How much risk can you afford? Are you taking too much risk? Do you need to dial it down? Do you need to create some asset classes that are more income generating, tax efficient, principal protected, even tax free? Or are we looking at this from a standpoint of, passing on to heirs, which we'll get to in a minute? Okay, so then there's a tax plan, and I kind of integrated that. The first three really work together. How do you invest? How do you create income? And how do you save the most amount in taxes? Do you want to pay taxes now on less money and get it out of the way and never pay tax again, which you might be able to do? Or would you rather pay taxes as you go for the rest of your life on an account that might continue to grow? Well, we can put that out on a spreadsheet and see what makes the most sense. It's kind of like a farmer who buys $100,000 worth of seed for his field. And the accountant quickly says, you can write that off. It's $100,000. Well, what if there was a law? And by the way, in a year or two, you're going to end up with $1 million of crops to sell, all of which basically you can write off the $100,000. But then what? Then all the crop sales are gains and are taxable. What if you could say, you know what, I'll pay all the taxes on the grain, I'll plant my field and everything, but can I just sell it tax-free when I get the money? Sure, okay. Well, what if that was available to you in a retirement plan? Well, it is. It's called a Roth IRA. It's also called LIRP, Life Insurance Retirement Plan. You pay taxes now on that money at whatever the value is, but you don't pay taxes for the rest of your life at whatever bracket might come to be. And I don't think the tax brackets are going to go down over the next 30 or 40 years. I have a pretty good feeling they're going to go up because politicians do math one day. It's income versus outgo. It's not about economic supply demand, creating more taxes through accommodating tax practices, which Donald Trump did and actually showed the fact that they could raise more tax money by lowering tax rates. Why? Because people spend more, invest more. And because they're not sending it all to the government, they actually keep it in play in the economy for several steps before it ends up, in Washington down the black hole. So we want to make sure that investment, the income, and the tax plan is all, meshing nicely together. So, then the other two are really not after the fact, but they're important too. How do you take care of healthcare, those healthcare needs, like the long-term care issues? Do you self-insure? Do you buy some sort of a plan that covers that? And then how do you give what you have left to who you want, how you want, with least amount of trouble, taxes, and avoiding probate? That's the estate plan. We can do that through trust or just, creative allocation and distributions through beneficiary assignment. So again, those are the 5 pillars of planning. If you don't have all of them in your plan, then I believe you're lacking. And unfortunately, too many companies in our business, too many advisors that should do better, leave them all out. All they do is say, I want to get a fee. I'll just take care of your stocks and bonds, do a 40-60 and, pay me a fee and I'll go golfing every day and we'll check up every year. Well, that's not a plan. That's just that's a portfolio manager is not given any value for what they're supplying, in my opinion. So we like the full comprehensive plan. We like taking care of all the pillars of your plan, and we like making sure that you sail off into that retirement sunset, knowing that you're safe and that you're going to be okay.
So once again, that's our 5-point retirement review that's in our retirement roadmap, and the number to get yours, 520-780-9059, 520-780-9059. Hey, Jeff, we're out of time for this week. I want to thank you for your time, but most of all, I want to thank our listeners for joining us here in the greater Tucson area. For Jeff Hogan, I'm Jeff Shade. Have a great weekend, won't you? We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.